Swayam Prabha. Digital India. Educated India.
योगः कर्मसु कौशलम्.
Hello students, I, Dr. Dhaval Nakum from Gujarat University welcomes you all to the fourth part of accounting concepts, conventions and principles and accounting standards. In the previous module, we have studied going concern concept, cost concept, realization concept, dual aspect concept, conservatism, consistency and lastly the materiality concept. All these aspects are explained with the accounting treatments and their presentation in financial statements. I am sure that you must have acquired a reasonably good understanding for them. The clarity about all accounting concepts, conventions and principles will put you in a comfortable condition to learn advanced issues of accounting. In this module, we will discuss accounting standards which are having vital role in preparation and presentation of annual financial statements. We will acquire information about meaning, need, importance of accounting standards and a preliminary understanding of accounting standards. Let us commence with it. A set of norms always makes system very uniform and comparable. The functioning of accounting is also based on certain concepts, conventions and principles. Further, accounting is considered to be one of the important professions across the world. All over the world, every country has its own accounting regulatory system. In India, we have professional body, the Institute of Chartered Accountants of India, ICAI. This body plays a vital role in accounting education and accounting profession related issues. Financial statements are not confined to accounts preparers, but are shifting to public domain under the regulatory system. Accounting as a language of business communicates the financial results of an enterprise to various stakeholders by means of financial statements. Different types of qualitative features of financial statements are developed like transparency, consistency, comparability, adequacy and reliability for financial reporting. If the financial accounting process is not properly regulated, there is possibility of financial statements being misleading, tendencies and providing a distorted picture of the business rather than the true state of affairs. To sustain the qualitative features of financial information, ensure transparency, consistency, comparability, adequacy and reliability of financial reporting. Along with concepts, conventions and principles, formation of accounting standards are inevitable. In addition to this, accounting standards provide framework and standard accounting policies so that the financial statements of different enterprises become comparable. Now let us see the meaning of accounting standards. Meaning of accounting standards. Accounting standards are written policy documents and are to be implemented by affected business organizations. These standards are issued by expert accounting body ICAI or by the government or other regulatory bodies. The apparent objective of the standard setting bodies is to promote the spreading of timely and useful financial information to shareholders and other stakeholders having an interest in the company's financial statements. The accounting standards deal with the four important aspects of number 1, recognition of events and transactions in the financial statements, number 2, measurement of these transactions and events. Number 3, presentation of these transactions and events in the financial statements in a manner that is meaningful and understandable to the reader. And lastly, number 4, that is disclosure requirements. Let us understand need of accounting standards. Need of accounting standards. Number 1, to bring harmonization in accounting policies. Number 2, to make financial information comparable, that is intra-comparison and inter-comparison. Number 3, standardize accounting information disclosure. Number 4, to eliminate subjectivity of accounts preparers. And number 5, to improve the reliability of accounting information. How accounting standards are useful to different stakeholders, let us see that aspect. Importance of accounting standards. Accounting standards are the ruling authority in the world of accounting. It ensures that the information provided to potential investors is not misleading in any way. Uniformity in financial disclosure. Accounting standards provide a uniform set of rules. They even have a standard format for financial statements. These steps achieve uniformity in accounting methods. For example, methods of inventory valuation. Accounting standard number 2 permits the use of only FIFO or weighted average cost formula for determining the cost of inventories. This restriction brings uniformity in accounts, means presentation and preparation of financial statements in a uniform manner. Next is reliability of financial statements. The use of financial statement is not confined to internal use, but it is legally used in public domain also. There are many stakeholders of a company and they rely on the financial statements for their information. Different stakeholders use these financial reports for different purposes. So, it is essential that these statements must present a true and fair picture of the financial status of the concerned company. The accounting standards establish trust in different stakeholders. They ensure the statements are reliable and trustworthy. Next is prevents frauds and accounting manipulations. The basic and important aim of accounting standards is to bring and maintain objectivity in accounts. Accounting standards deal with recognition, measurement, valuation and disclosure of transactions and events. These dealings doesn't allow any kinds of subjectivity to accounts preparers. Accounting standards make obligatory to follow accounting principles and methodologies. One of the important benefits of accounting standards is that the management of an entity cannot manipulate financial data. The mandatory implementation of accounting standards does not provide any room for frauds and manipulation of results. Next is assist auditors. The existence of accounting standards makes the auditing task very comfortable and easy. The auditor's role is to check whether the proper execution of accounting standards is done or not by the company. Now, the accounting standards lay down all the accounting policies, rules, regulations, etc. in a written format. These policies have to be followed. So, if an auditor checks that the policies have been correctly followed, he can be assured that the financial statements are true and fair. Next is comparability. This is another major objective of accounting standards. Since all entities of the country follow the same set of standards for their financial accounts, they become comparable. The users of the financial statements can analyze and compare the financial performances of various companies before making any decisions. Also, two statements of the same company from different years can be compared. This will show the growth curve of the company to the users. Next is determining managerial accountability. The accounting standards help measure the performance of the management of an entity. It can help measure the management's ability to increase profitability, maintain the solvency of the firm, and other such important financial duties of the management. Management must also wisely choose their accounting policies. Constant changes in accounting policies lead to confusion for the users of these financial statements. Further, the principle of consistency and comparability is also lost. Every concept has certain limitations and accounting standards also have certain limitations. Let us see them. Limitations of accounting standards. There are few limitations of accounting standards as well. The regulatory bodies keep updating the standards to restrict these limitations. Number 1, difficulty between choosing alternatives. There are alternatives for certain accounting treatments or valuations. For example, stocks can be valued by LIFO, FIFO, weighted average method, etc. So, choosing between these alternatives is a tough decision for the management. In India, two methods are permitted only. Number 2, restricted scope. Accounting standards cannot override the laws or statutes. They have to be framed within the confines of the laws prevailing at the particular time. That can limit their scope to provide the best policies for the situation. Since in India, accounting standards are concerned with ICAI, let us see its overview. Overview of the accounting standards in India. In India, the Institute of Chartered Accountants of India, ICAI, being a premier accounting body in the country, is responsible for the formation of accounting standards. This is done by the Accounting Standards Board ASB of ICAI, established on 21st April 1977. The main function of ASB is to formulate accounting standards so that such standards may be established in India by the Council of the ICAI. The accounting standards issued by the Accounting Standards Board establish standards that have to be compiled with by the business entities so that the financial statements are prepared in accordance with generally accepted accounting principles. The given explanation is based on guidelines provided by the ICAI. Applicability of accounting standards to companies other than those following Indian accounting standards, that is Ind AS. Accounting standards as of February 1, 2022, AS number 1, disclosure of accounting policies, AS number 2, valuation of inventories, AS number 3, cash flow statements, AS number 4, contingencies and events occurring after the balance sheet date, AS number 5, net profit or loss for the period, prior period items and changes in accounting policies, AS number 7, construction contracts, AS number 9, revenue recognition, AS number 10, property, plant and equipments, AS number 11, the effects of changes in foreign exchange rates, AS number 12, accounting for government grants, AS number 13, accounting for investments, AS number 14, accounting for amalgamations, AS number 15, employee benefits, AS number 16, borrowing cost, AS number 17, segment reporting, AS number 18, related party disclosures, AS number 19, leases, AS 20, earnings per share, AS 21, consolidated financial statements, AS 22, accounting for taxes on income, AS 23, accounting for investments in associates in consolidated financial statements, AS 24, discontinuing operations, AS 25, interim financial reporting, AS 26, intangible assets, AS 27, financial reporting of interest in joint ventures, AS 28, impairment of assets, AS 29, provisions, contingent liabilities and contingent assets. Now we will understand objective of each standard in brief. AS1 Disclosure of Accounting Policies issued in 1979. Financial accounting deals with preparation and presentation of annual accounts. During preparation of annual accounts, what kinds of policies are to be followed are given in this accounting standard. Objective: this standard deals with the disclosure of significant accounting policies followed in preparing and presenting financial statements. Next is the view presented in the financial statements of an enterprise of its state of affairs of the profit or loss can be significantly affected by the accounting policies followed in the preparation and presentation of the financial statements. Next is the disclosure of some of the accounting policies followed in the preparation and presentation of the financial statements is required by law in some cases. Next is the Institute of Chartered Accountants of India has, in standards issued by it, recommended the disclosure of certain accounting policies. For example, translation policies in respect of foreign currency items. Next objective is, in recent years, a few enterprises in India have adopted the practice of including in their annual reports to shareholders a separate statement of accounting policies followed in preparing and presenting the financial statements. Next is, in general, however, accounting policies are not at present regularly and fully disclosed in all financial statements. Many enterprises include in the notes on the accounts description of some of the significant accounting policies, but the nature and degree of disclosure vary considerably between the corporate and the non-corporate sectors and between units in the same sector. Next is, even among the few enterprises that presently include in their annual reports a separate statement of accounting policies, considerable variations exist. The statement of accounting policies forms part of accounts in some cases, while in others it is given as supplementary information. Next is, the purpose of this standard is to promote better understanding of financial statements by establishing through an accounting standard the disclosure of significant accounting policies and the manner in which accounting policies are disclosed in the financial statements. Such disclosure would also facilitate a more meaningful comparison between financial statements of different enterprises. Next is AS2 Valuation of Inventories, revised in 2016. The closing value of inventory has great impact on profit measurement and financial position. This AS is providing information about which method of valuation of inventory should be used. Now, we will see the objectives of this particular AS. Number 1, a primary issue in accounting for inventories is the determination of the value at which inventories are carried in the financial statements until the related revenues are recognized. Next is, this standard deals with the determination of such value, including the ascertainment of the cost of inventories and any write down thereof to net realizable value. Third AS is AS3 Cash Flow Statements, revised in 1997. There are three important components of the financial statements. 1. Income statement, number 2. Balance sheet, and number 3. Cash flow statement. This AS deals with all cash inflow and cash outflow activities. Now, we will see the objectives. Information about the cash flows of an enterprise is useful in providing users of financial statements with a basis to assess the ability of the enterprise to generate cash and cash equivalents and the needs of the enterprise to utilize those cash flows. The economic decisions that are taken by users require an evaluation of the ability of an enterprise to generate cash and cash equivalents and the timing and certainty of their generation. The standards deals with the provision of information about the historical changes in cash and cash equivalents of an enterprise by means of a cash flow statement, which classifies cash flow during the period from operating, investing and financing activities. Fourth accounting standard is AS4, contingencies and events occurring after the balance sheet date, which is revised in 2016. There is time gap between closing date of accounts prepared and the date of accounts approved by the management. Therefore, there can be certain events which may have significant impact on annual accounts of the company. There can be certain transactions or events which might not be matured due to legal issues. These uncertainty also requires attention. It is necessary to bring to the notice of shareholders about such transactions and events. Thus, this particular AS is developed and implemented. Now, we will see the objectives. This standard deals with the treatment in financial statements of number A, contingencies and number B, events occurring after the balance sheet date. The subjects which may result in contingencies are excluded from the scope of this standard in view of special consideration applicable to them. A. Liabilities of life assurance and general insurance enterprises arising from policies issued. B. Obligations under retirement benefit plans. And C. Commitments arising from long-term lease contracts. Now, the fifth accounting standard is AS5, net profit or loss for the period, prior period items and changes in accounting policies, which is revised in 1997. The objective of this accounting standard is to prescribe the criteria for certain items in the statement of profit and loss, so that comparability of the financial statements can be enhanced. Statements of profit and loss, being a period statement, covers the items of the income and expenditure of the particular period. A company prepares its final accounts for the year ending on 31st March 2024. This implies that all the items of the income and expenditure appearing in the statement of profit and loss pertain to the period from 1st April 2023 to the 31st March 2024. However, there may be a situation where particular income or expense appearing in the statement of profit and loss for the year ended on 31st March 2024 may not relate to the period from the 1st April 2023 to the 31st March 2024. In that situation, what should be the accounting treatment and presentation of such item in the statement of profit and loss is prescribed by this accounting standard. This accounting standard also deals with changes in accounting policy, accounting estimates and extraordinary items. Illustration to understand this accounting standard. An employee of the company, Shri Prakash, went on leave with pay for 9 months on 1st January 2023 up to the 30th September 2023. His monthly salary, monthly pay was rupees 15,000, while preparing the financial statement on 30th June 2023 for the year ended on 31st March 2023, the expense of salary of Shri Prakash for 3 months, that is from the 1st January 2023 to the 31st March 2023, was not provided due to the omission. When Shri Prakash joined on 1st October 2023, the whole salary for 9 months, that is from the 1st January 2023 to the 30th September 2023, was paid to him. In this case, 3 months salary, that is from the 1st January 2023 to the 31st March 2023, of rupees 45,000 is prior period expense, an accounting entry should be passed. Salary account debited with the amount of 90,000. Prior period expense account also gets debited, that is salary of 45,000 rupees, to bank account rupees 1,35,000. Now, we will see the objectives. The objective of this standard is to prescribe the classification and disclosure of certain items in the statements of profit and loss, so that all enterprises prepare and present such a statement on a uniform basis. This enhances the comparability of the financial statements of an enterprise over time and with the financial statements of other enterprises. Accordingly, this standard requires the classification and disclosure of extraordinary and prior period items and the disclosure of certain items within profit or loss from ordinary activities. Next is, it also specifies the accounting treatment for changes in accounting estimates and the disclosure to be made in the financial statements regarding changes in accounting policies. Next accounting standard is AS6 depreciation accounting, which is revised in 1994. It is important to note that AS6 accounting for depreciation stands withdrawn and such matters related to depreciation is included in AS10. Next accounting standard is for construction contracts, AS7 construction contracts, which are revised in 2002. Final accounts means annual accounts are prepared after every 12 months, but duration of contracts may be more than 1 year, it may be of a period of 5 years. In this situation, how to determine profit of respective accounting year where contract is not completed? For these kind of cases, accounting standard 7 is used. Now, we will see the objectives. The objective of this standard is to prescribe the accounting treatment of revenue and cost associated with construction contracts. Because of the nature of the activity undertaken in construction contracts, the date at which the contract activity is entered into and the date when the activity is completed usually fall into different accounting periods. Therefore, the primary issue in accounting for construction contracts is the allocation of contract revenue and contract cost to the accounting periods in which construction work is performed. This standard uses the recognition criteria established in the framework for the preparation and presentation of financial statements to determine when contract revenue and contract cost should be recognized as revenue and expenses in the statement of profit and loss. It also provides practical guidance on the application of these criteria. Next accounting standard is AS9 revenue recognition, which is issued in 1985. Annual accounts are prepared under mercantile system. Further, sales are most important component of revenue. So, revenue recognition is very crucial issue because sales are done in the form of lease or hire purchase also. The determination of amount of sales is not easy like cash and credit sales. To compute precise sales from such activities, this accounting standard is used. Now, we will see the objective of this accounting standard. This standard deals with the basis for recognition of revenue in the statement of profit and loss of an enterprise. The standard is concerned with the recognition of revenue arising in the course of the ordinary activities of the enterprise from the sale of goods, the rendering of services and the use by others of enterprise resources yielding interest, royalties and dividends. This standard does not deal with the following aspects of revenue recognition to which special consideration apply. Number 1, revenue arising from construction contracts. Number 2, revenue arising from hire purchase lease agreements. Number 3, revenue arising from government grants and other similar subsidies. Number 4, revenue of insurance companies arising from insurance contracts. Now we will see the accounting standard number 10, that is AS 10, which is revised in 2016, property, plant and equipment. In balance sheet, two types of assets are disclosed, non-current assets and current assets. Further classification of assets is tangible and intangible assets and real assets and fictitious assets. The role of tangible non-current assets is significant. This standard deals with recognition, measurement and disclosure of property, plant and equipments. Now we will see the objectives. The objective of this standard is to prescribe the accounting treatment for property, plant and equipment so that users of the financial statements can discern information about investments made by an enterprise in its property, plant and equipments and the changes in such investments. The principal issues in accounting for property, plant and equipments are the recognition of the assets, the determination of their carrying amount and the depreciation charges and impairment losses to be recognized in relation to them. Next is AS 11, effects of changes in foreign exchange rates, which is revised in 2018. When business transactions are done with the international firms and payment is to be made or to be received other than Indian currency, the problem of foreign exchange rate difference arises. The difference may be favorable or adverse. How to incorporate such differences in final accounts is covered under these accounting standard. Now we will see the objectives. An enterprise may carry on activities involving foreign exchange in two ways. It may have transactions in foreign currencies or it may have foreign operations. In order to include foreign currency transactions and foreign operations in the financial statements of an enterprise, transactions must be expressed in the enterprise's reporting currency and the financial statements of foreign operations must be translated into the enterprise's reporting currency. The principal issues in accounting for foreign currency transactions and foreign operations are to decide which exchange rate to use and how to recognize in the financial statements the financial effect of changes in exchange rates. In this module, we had a discussion on accounting standards, which plays a vital role in the preparation and presentation of annual financial statements. We had acquired information about meaning, need and importance of accounting standards, preliminary understanding of accounting standards covering accounting standards from 1 to 11. In the final part of accounting concepts and accounting standards, we will study the objectives of the remaining accounting standards from AS 12 to AS 29. Thank you guys. I hope you have enjoyed the session. Thank you.